Imagine waking up one morning, checking the news, and seeing this headline everywhere. Global markets collapsing. Banks freezing withdrawals. Stock markets crashing. Governments panicking. But the scary part, the thing that triggered it, was something most people have never even heard of. Not stocks, not crypto, not real estate. Something called derivatives. And the total size of this market is around $300 trillion. Let that sink in for a moment. 300 trillion. That's more money than the entire global economy produces in a year. So here's the question. If this market is so massive and so important, why does almost nobody talk about it? Because derivatives are complicated. But once you understand them, you start to see something unsettling. A financial system built on layers of promises. Promises stacked on top of other promises. And when those promises break, the dominoes can fall very fast. So today, we're going to answer 3 questions. What are derivatives? Why are they worth hundreds of trillions of dollars? And why some economists believe they could trigger the next financial crisis. Let's start with a very simple example. Imagine 2 people, a farmer and a baker. The farmer grows wheat. The baker makes bread. The baker knows he will need wheat 6 months from now. But there's a problem. Wheat prices change all the time. If prices go up, the baker could lose money. So the 2 of them make a deal. The baker agrees to buy wheat in 6 months for $10 per bag, no matter what the market price is later. This type of agreement is called a contract. Simple, predictable, and useful. But now, something interesting happens. Imagine another bakery owner wants that same deal. So the baker sells the contract to someone else. Now suddenly, the contract itself can be traded. That's the basic idea behind derivatives. A derivative is simply a financial product whose value comes from something else. It might come from wheat, or oil, or currencies, or interest rates. In the beginning, derivatives were actually helpful. Farmers used them, airlines used them, companies used them to protect themselves from price changes. But over time, something changed. Investors realized something powerful. You didn't actually need the wheat. You didn't need the oil. You didn't even need the real asset. You could trade the contract itself. And that's when derivatives started to explode. Today, derivatives are everywhere. Banks use them. Hedge funds use them. Corporations use them. Even governments use them. These contracts allow people to bet on interest rates, currencies, stock markets, commodities, inflation. Almost everything in the global financial system has derivatives attached to it. But here's where things get risky. Because derivatives are contracts, you can stack them. Imagine this: one contract based on wheat prices, another contract based on that contract, then another contract based on that one. Layers on top of layers. This is called leverage, and leverage can make money very quickly, but it can also destroy money just as fast. We saw this happen in 2008. Before the financial crisis, banks were trading derivatives linked to housing mortgages. These contracts were supposed to spread risk. Instead, they multiplied it. When housing prices began falling, those contracts started losing value. Banks stopped trusting each other. Credit markets froze. And suddenly, the entire global financial system was on the edge of collapse. Governments had to step in. Trillions of dollars in bailouts, emergency interest rate cuts, massive money printing, all to stop the dominoes from falling. And remember, that crisis was triggered by just a small part of the derivatives market. So imagine what could happen today when the market is far larger. Today, economists estimate the global derivatives market is worth around $300 trillion. To understand how big that is, Consider this. The entire global economy produces about $100 trillion of goods and services per year, which means the derivatives market is several times larger than the real economy itself. Now, to be fair, not all of that represents real risk. Many contracts cancel each other out, but the real danger comes from something else: interconnection. Banks owe money to other banks. Funds owe money to banks. Companies rely on those funds. And governments rely on the entire system working, which means one failure can spread very quickly, like a row of dominoes or a power grid blackout. And we've already seen warning signs: flash crashes, liquidity scares, sudden hedge fund collapses. Each time, central banks step in to stabilize the system. Derivatives themselves are not evil. They're tools, like knives. Useful when handled carefully. Dangerous when used recklessly. The real issue is scale. The modern financial system has become incredibly complex. Contracts linked to contracts, linked to more contracts, a giant web of financial promises. Most of the time, that web holds together. But history has shown something important. When enough pressure builds, even the strongest systems can snap. Which is why economists continue watching this market closely. Because if something breaks, it won't just affect traders on Wall Street. It could affect loans, savings, jobs, entire economies. And that's why the $300 trillion derivatives market might be one of the most important financial systems that most people have never heard of.